The importance of interest rates changes sneak into your wallet like a Netflix subscription you forgot to cancel. We'll talk about how they can flip our daily lives upside down, why the Fed's rate hike announcement somehow makes your cup of coffee cost an extra buck, and what little tricks we can use to stay ahead. I'll keep it fun, promise. Thanks for hanging out with me. Let's jump in. What even is an interest rate? At the simplest level, an interest rate is the price you pay to borrow money, or the reward you get when you lend it. That's the technical version. Put it plainly, if you borrow $100 from a bank and they ask for $101 back, that extra $1 is the interest. Lenders charge a percentage of the amount they lend each year. Savers earn interest on their deposit balances. Now, a little technical clarity. When I say lender, I mean banks, unless you went to a loan shark, in which case, well, that's on you. And yes, I can already hear someone yelling, aren't banks just loan sharks? Sadly, I can't approve that take. This is a semi-serious channel and I'm a content creator, not a courtroom. If a bank ever offers me a sponsorship, sure, I'll probably sell out like a true slave to capitalism. So no, banks are not loan sharks. Moving on. And when I say savers, that's you. Stop spending everything and put some of that cash to work. Whatever you invest in, just have something invested. The concept of interest might seem simple, but it shapes nearly every economic decision. For example, the Fed raises rates to try to get inflation under control. That's not the only reason, but it's one major one. By hiking rates, the Fed nudges people to park money in banks instead of splurging, and that cuts spending. Less spending equals less demand. When demand falls, you get excess supply. When supply outpaces demand, prices tend to drop. Here's a question for you. If demand disappears, wouldn't producers stop making goods they can't sell? And if they do stop, what happens next? Fire up the comments. You'll get the answer later in the video. Quick quote, an interest rate is the price paid for borrowing a sum of money. I'll slip in short technical quotes like that to make the video look more professional. If something's confusing, ask in the comments. I'll answer. And if for some reason I don't answer, someone else who reads the comment definitely will. Ask away, be chill. No one's going to laugh at you, and if they do, I'll be right there to put hot sauce in their mouth. Who decides the official interest rate? And how? Central banks, like the Fed, the Bank of England, or the ECB, set policy rates to influence the cost and availability of credit. Now you're probably thinking, cost of credit? Availability? I just walk into a bank and get a loan, right? Sorry, it's not that simple. Ever heard of foreign reserves? That's basically the stash of money a country holds. The bigger the stash, the stronger the player. Central banks exist to manage those reserves. For banks, money itself is the product. Just like Tesla is Elon Musk's product, money is a bank's product. When you or a company borrow, the bank gives you that product and charges you a profit. And by the way, policy rates aren't the only tool central banks have. They've also got things like reserve requirements, open market operations, and their own lending/borrowing rates. Don't panic, that sounds way too technical. I'm not here to give you a PhD in economics. What you need to know is simple. The rate the central bank sets directly impacts what you'll end up paying on your loans. Central banks don't dictate every retail loan rate, but they do control short-term rates and the financial conditions banks use to price credit. So when the Fed raises its policy rate, banks usually raise borrowing costs and maybe give savers a little better return. Or the reverse when rates drop, as the Bank of England itself puts it. We set bank rate to influence other interest rates and to keep inflation low and stable. Here's where it hits you. When rates go up, people with money stop spending as much and stash it in banks to earn interest. Don't underestimate how powerful that number is. It can cut demand big time. And it's not just the rich cutting back. Imagine you're about to buy a car. You don't have the cash, but your salary feels solid, so you think, I'll take out a loan, no problem. Right then, the Fed raises rates. Yesterday, a $10,000 loan meant $12,000 in repayments. After the Fed's move, the bank now wants $14,000 back. What do? Unless you're absolutely desperate for that car, you probably say, I'll wait. And just like that, one less car sold. Now multiply that by thousands of people across the country. Car sales tank. But automakers like Ford can't just shrug. That car you skipped buying will turn into an old model once the new year hits. So what does Ford do? Pause the video, Drop your guess in the comments. Got it? Okay, Ford either cuts prices or runs a promo to move those cars. And remember that earlier question. If demand falls, do producers just stop making stuff? Well, think about Ford again. They've got supplier contracts, annual budgets, warehouses full of parts. They can't just flip a switch and stop. So they keep producing, but to sell, they slash profit margins. That's why when your loan jumps from $12,000 to $14,000, some company out there is eating that extra $2,000 difference by lowering their margin. If central banks keep rates high for long, next year those same companies adjust, producing less to avoid the squeeze. Less supply plus recovering demand equals prices go back up. Economy equals delicate balance. If policymakers aren't careful, they can crash GDP while trying to tame inflation. How are we doing so far? I'm trying to keep this balanced, explaining the chaos without drowning you in technical mumbo-jumbo. If I pulled it off, I think I've earned a little like. So if you agree, now's the perfect time. Hit that like button and don't forget to subscribe. How do interest rate changes hit your wallet? I've kind of been talking about this since the start, but hey, what's the harm in diving deeper, right? When the Fed, or any central bank, tweaks policy rates, the ripple effect spreads through the economy in a few ways. 1. Borrowing costs, the direct hit. Mortgages, car loans, business loans, they all get more expensive or cheaper. That changes monthly payments and whether people even take out loans. Remember my Ford example? Same deal here. But think smaller too. You don't need to be Ford. Maybe you're just running a coffee shop or an auto repair shop. Guess what? You still need credit. And yes, even your neighborhood cafe feels the Fed's decision. So please, dear cafe owner, don't turn my daily coffee into a luxury item. Please. I'm begging you. Savings returns, the income channel. Banks might raise deposit rates, which means savers earn more. But here's the catch. Banks are super quick to jack up borrowing rates, while forgetting to raise savings rates. Thanks, capitalism. So if you're saving, don't expect instant fireworks. But if you're borrowing, boom, higher costs, almost overnight. Don't cuss me out. Life's just unfair like that. Asset prices and amp. The wealth effect. Low rates usually pump up stock and housing prices. Homeowners feel richer, so they spend more. High rates do the opposite. Think of it like this. When I can't make much on savings, my primal instincts kick in. I spend like crazy. Demand rises. When demand rises, prices follow. But don't panic. It doesn't mean prices instantly skyrocket. Producers sell more, produce more, cut costs, and profits go up. Everybody wins. At least for a while. Exchange rates and amp. Trade higher rates attract foreign money, strengthen the currency, and shift import-export prices. So no, high rates aren't all bad. Sometimes it means oil-rich investors flood in with billions. Companies export more, margins improve, and your currency looks shiny and strong. Hard to complain about that part. Expectations and confidence. Central bank announcements can shake markets before a single rate even changes. Investors plan around expectations. If the Fed does the opposite, markets freak out. It's like betting on SpaceX. Everyone's hyped for a $100 billion profit announcement. You throw your life savings into the stock. If Elon Musk shows up and actually delivers, price goes up. But if he tweets something bizarre instead, you know he might, the whole market flips. Yeah, expectations get priced in early. And hey, use the internet for more than just binge watching YouTube. Do some research. Kidding, kidding. Stay here. This video is literally the easiest breakdown you'll find. Bonus note, Mortgage Edition studies show that when mortgage rates drop, households refinance, free up cash, and boom, spending spikes. Because let's be real, when you suddenly have extra cash, you're not stashing it under the mattress. You're buying a new phone, a laptop, maybe even a car, or at least a bike. Doesn't matter what, it's getting spent. Borrowers increase spending after refinancing. Interest rates and inflation. The Central Bank Balancing Act. I've been hammering this point since the start. Interest rates directly affect inflation. And you still haven't liked or subscribed. That's fine. I still love you anyway. Here's the deal. Central banks raise rates to cool demand and bring inflation down. They cut rates to boost growth and jobs. The mechanism is simple. Higher borrowing costs, less spending/investment, slower price growth. But it's always a balancing act. Raise too fast and you freeze hiring and investment. Keep them too low and inflation sticks around like that one relative who never leaves the party. Now let's line it up like dominoes. Higher rates mean demand drops, investments stall. Why risk building a factory when I can dump cash into the bank and get fat returns for doing nothing? If no one invests, no new jobs are created. But, spoiler, people don't stop having babies just because rates went up. New workers keep entering the market, which naturally pushes unemployment higher. So basically, at high interest rates, you either stop making babies or learn about birth control. But here's the twist. What if elections are coming up? The government really doesn't want high unemployment numbers on the scoreboard. In that case, they might lean toward keeping rates lower, even if inflation's a headache. The political side of economics could fill an entire book, but let's be real, you wouldn't read it. So let's just leave it right here. Changes in these rates influence the lending activities of banks and other financial institutions. What happens if interest rates stay high for too long? If interest rates stay high for a long time, things get tricky. Over-leveraged households with mortgages feel the squeeze. Highly indebted companies struggle to roll over debt, and some banks face bond losses. Growth slows down, but yes, inflation pressures also cool off. Institutions like the IMF keep warning. Prolonged high rates create financial stress for fragile borrowers and lenders. Thanks, IMF, for the reminder. Now, if you've been paying attention up to this point, you already know the story. And honestly, if I keep going too technical here, you'll probably get bored and click away. So let's flip the script. In the next part, I'll bring it straight to your wallet. What high rates mean for you, personally. Don't skip this. It's actually the most important part. How do interest rates hit your home? Mortgages, variable rates if your loan is tied to short-term rates. Even a 1% hike can add hundreds of dollars to your monthly payments. For example, a $300,000 mortgage over 30 years costs about $1,610 per month at 5%. Push that to 6%, and suddenly you're paying around $1,798. That's an extra $188 every month. And that's just from 1%. No taxes or insurance included, by the way. Refinancing, fixed rates when long-term bond yields drop. 30-year mortgage rates also fall, giving homeowners a refinancing opportunity. According to the NBER, this often boosts household spending. Let's say you're paying $1,000 per month and refinance down to $800. Great! You've got $200 left over. Now you're probably thinking, I'll invest it in a fund, get 10% returns, and retire rich. Yeah, right. Realistically, Adidas just launched a new sneaker. The iPhone 17 Pro Max looks shiny. Or Amazon has something you didn't even know you needed. Humans are wired to chase gratification. Even scrolling YouTube Shorts is proof. In the end, if you've got extra cash, odds are you'll spend it. Credit cards and AMP, consumer loans, these usually track short-term policy rates. When the central bank hikes, credit card APRs rise too. Now imagine me saying, don't use credit cards. Only pay cash. If you don't have cash, don't buy. What's your reaction? Probably not great. I get it. Cards feel essential today. Maybe you think, I'm disciplined, I spend within my income, and I pay in full every month. So what's the harm? Fair point. But here's a challenge. Leave your credit card at home for just 1 month and use only cash. You'll be shocked how much less you spend. Psychology kicks in. When your wallet gets thinner, you hold back. Cards don't trigger the same restraint. Savings accounts. Yes, when policy rates rise, banks raise deposit rates, but slowly, and usually less than they hike loan rates. And hey, one last note. We already covered the topic of forgetfulness earlier. Also, swearing is rude. Please don't do it. How should you react to interest rate changes? If rates are climbing and you've got a variable rate loan, think about locking in a fixed rate or paying down principal faster. High rates and short-term savings. Look into high-yield accounts or short-term bonds. Way better than stashing cash under your mattress. Expecting rates to drop? Refinancing that high-rate mortgage could free up cash for spending or investing. Just watch out for closing costs. Thanks, NBR. A big tip. Don't treat central bank announcements like day trading signals. Focus on long-term market moves. Mortgages and long-term loans react more to the bond market than to policy rates, as Wall Street Journal puts it. The market prices and expectations. It sells reality. In other words, by the time the news hits, it's usually too late. So, if you're planning short-term investments, keep that in mind. Common misconceptions about interest rates. Misconception number 1. If the Fed raises rates, my mortgage rate goes up by the same amount. Wrong. Short-term rates and long-term mortgage rates generally move together, but not one-to-one. Long-term rates are also shaped by the bond market and market expectations. Wall Street Journal, misconception number 2. High interest rates always benefit savers. Partially wrong. Banks usually raise deposit rates slowly, and inflation can still eat into your real returns. Bank of England, remember, banks never pay interest above the inflation rate. Your money is almost certainly losing value in real terms. The key is minimizing that loss. One way: build an investment basket. What's an investment basket? Spread your money across multiple areas. Some in savings, some in stocks, some in bonds, some in precious metals. Not only can this help preserve your wealth, it also reduces risk. Conclusion: why interest rates matter. Interest rates are a powerful tool and one of the most important economic indicators. They help keep inflation in check, manage unemployment, and maintain the supply-demand balance. Post-pandemic, the global economic system hasn't fully recovered. As I mentioned earlier, the economy is delicate. Throw it off balance, and it can take decades to fix. And most of the time, the public ends up footing the bill for economic disruptions. Oh, here's the takeaway. Don't stop spending entirely, but don't go overboard either. You're the CEO of your own personal economy. Build your own balance and protect it. We need to act consciously. And the first step? Subscribe to the channel and hit the bell to stay informed. Take care of yourself and spend wisely.